Tonight, we have FU alumna Kathi Verbeek from Keller Williams Town Life in Tenafly, New Jersey, and Stephen Saladino, mortgage advisor with Bond Street Mortgage. Kathi graduated from FDU with a degree in marketing. She transitioned into real estate after an extensive business career in the fashion retail industry, working for organizations such as Macy's and Bloomingdale's, working her way up to become VP Business Process and Omnichannel Gatekeeper at Bloomingdale's. Kathi's success in business and now real estate is attributed to her top priority for her clients. That is to actively listen and assess her customers' needs to quickly recommend the best business solutions. Kathi is joined tonight by Stephen Saladino, mortgage advisor with Bond Street Mortgage, to speak to us about the current real estate market, where it's going, and help us navigate the process in buying our dream home. Thank you, Kathi and Stephen, for being with us tonight, and I'm happy to pass the screen over to the two of you.
Thank you, Ken, so much, and thank you, everyone, for joining us this evening. Stephen and I look forward to spending the next hour with you together for us to really talk about what's happening in the real estate market and perhaps the opportunity that you have in 2021 for yourself. So I think I'm going to go ahead and Ken share the screen. All right, hopefully everyone is seeing the slide presentation at this point in time. So as Ken said, my name is Kathi Verbeek and I'm with Keller Williams Town Life Realty, and we are thrilled to be here. Ken gave us our bios, so we won't repeat that information. So we're gonna dive right into this. Oh, let's see, I need to know where I'm going my next slide. Okay, so we have a question for all of you, and first question for this evening, and we're going to ask you to just put your answer in the chat. Do you rent or do you own a home currently? And Ken and Lorraine, if you can help us just see what the participants are saying, we'd appreciate that.
And it looks like most are renters.
Perfect. Okay, terrific. Well, we're going to talk about the opportunity for renting or buying a home this evening. So thank you again for joining us. You're in the right place. So just briefly to talk about our agenda for this evening, we're going to talk about the current market trends and why this market has been different in 2020 into 2021. We're going to talk a little bit about the pros and cons of renting and buying, and then how do you go about finding your home, the importance of pre-approval, and then as Ken said, we're going to be going through a Q&A. So we've recorded what questions you've given us so far, but we certainly are open to other questions. So let's take a few moments and just talk about the current situation. And I understand that we may have people on with us this evening may not all be in New Jersey. There may be some others from other parts of the country or even possibly Canada. What I did was I focused on North Jersey for our time together tonight, but I will tell you that the trends that we're seeing here in New Jersey and North Jersey are very similar across the country. I was in a corporate meeting a few weeks ago and they really do line up. And so what does that all mean? So, you know, first of all, and I'm not going to really spend time on actual statistics, but insight and what's going on. So what we're seeing are extremely strong home sales, and in particular, single family residence is where the thrust is. And that's really people, you know, going out to the suburbs and in fact traveling further than perhaps they originally thought they would, because we all know with remote work now, people are willing to travel a little farther because they don't really have that same commute that they have to worry about. We are seeing that it's tougher in cities and the urban areas. And, you know, part of that is about vertical living. You know, with the pandemic this past year, we know that being in, you know, tight spaces being in like sharing elevators, or the fact that you maybe had to go in an elevator one at a time, was something that, you know, people started leaving the city and the urban areas. So we saw people migrating out of New York. We saw people moving out of Hoboken or Jersey City. And so that impacts the home strong sales, because with the pandemic, people either accelerated their plans or honestly put their plans on hold. But the home sales are certainly reflective of those that decided to accelerate their plans. Home prices increase, and we've seen that over this past year and continue in 2021. When we think about the low interest rates that Stephen will talk about and the low inventory, so we don't have a lot of homes for sale out there. And that's really with sellers who have hesitated putting their home on the market because of the pandemic, and perhaps saying they're not ready to move to another location. Quite often I hear sellers say, where am I going to go? And, you know, until we have as we roll out the vaccine, we are seeing low inventory. And that's created a bidding war situation that we'll talk about a little bit later. But quite frankly, we end up with more qualified buyers than we have homes to sell. What this means that we've got a very fast market. So the days on market are much shorter than they've been in the past. So the ability as being a qualified buyer to be able to move very quickly, you may only see a home once before you have to make a decision. And believe it, this statistic, it takes 8 seconds for a typical buyer to determine whether this is the right home for them. It's crazy, isn't it? When you think about what a big financial and emotional decision this is. 8 seconds to make a decision of it being the right home. Stephen, can you touch on low interest rates for me, please?
Yeah, we are, you know, it's not the lowest that it's ever been. We have had a little bit of upward pressure the last 2 months. However, you know, we're still very historically low, which has given people a lot more buying power, which has also, as Kathi said, you know, made it a lot more of a competitive market. But we still have really, you know, great rates. And, you know, honestly, it's not always just about the interest rate. It's really about the plan that you have that really, you know, makes it work for you. I wouldn't necessarily always focus on just the interest rate. You know, you really, the lowest interest rate with the wrong plan could be more expensive than the right plan, right? So we really want to make sure that we are, you know, fitting you into, you know, something that is really going to be comfortable for you on a monthly basis, which is the most important part.
And Stephen, right now, with the interest rates where they are, we're starting to see them slightly creep up a little bit. Do you have a thought? What are the indicators of what's going to happen this year?
Yeah, and we're kind of right at a tipping point. You know, the Fed has, you know, continued to say that they're going to use all the tools in their power to stimulate the economy. You know, what has really been keeping rates low is the quantitative easing that the Fed is doing, right? So they're currently buying $120 billion worth of treasuries and mortgage-backed securities every month. And that is what's keeping liquidity in the market, keeping interest rates low. And really the Fed's job is to fight inflation, right? So when we have, you know, a tougher time with the economy, they will do some quantitative easing to, you know, make, you know, cash readily available to people to lend. And so that liquidity, you know, brings interest rates lower to try to stimulate the economy. And when, you know, the economy starts to improve and, you know, we start to get to inflation levels where the Fed needs to monitor that, then they will kind of back off, you know, to balance things out a little bit. So it's not the lowest that it's ever been, but it is still very historically low. And, you know, the Fed has really been committed to, you know, keeping things that way for the next year or so.
Thank you, Stephen.
My pleasure.
So let's take a few moments and talk about what makes this market different and what we've seen this past year and as we go into this year. So first of all, you know, we've talked about already, I've mentioned living in the suburbs. We definitely have a demand for single family homes. The idea of moving and migrating out of the city and urban areas for more indoor and outdoor space. People want more square footage. And access to local activities, being able to walk and take advantage of, you know, downtowns and parks, and access to highways and access to the city. we are all technology savvy at this point, and that means not only in terms of how we look for our homes initially, but also in terms of how we conduct business, and that will continue to be very strong for us. Stephen already touched on the interest rate, so I'm not going to say much about that, except for with lower interest rates, buyers, it puts you as a qualified buyer, you end up getting more home for your money because you're able to put more money into the principal than into the interest. And what we're seeing are, really a tale of two cities. And those decisions of buyers deciding, do I want new and renovated? And what are the benefits of that? That may come at a higher cost being new, but it gives me move-in ready, perhaps less headaches. Could be more, smart technology, environmentally friendly, versus previously owned, better value and price, and a lot of charm. And who is it that is our main buyers out there? Well, at 38%, our two biggest generations right now in the housing market are millennials and our Generation Z. Right behind that is our Generation Xers. So Stephen, I think I turn it over to you.
That's my turn. All right. So just by typing in the chat like we had done before, or no, I'm sorry. So I'm just going to ask the question, is it better to rent or buy, right? So we're going to talk about, your current situation and, kind of the pros and cons of renting and buying. But I think the biggest factor is really your timelines, right? So Kathy, if Kathy would go to the next slide, we'll kind of see some of the pros and cons here. When you're renting at home, you do have a little bit more, flexibility to move, right? So if, your lease is up, you can just move out. You don't have to sell your home. There's a lot less, things to put on a moving truck because of square footage. You may not have as much stuff. So it is a little bit easier to move depending on, what you have, your timelines, if you're going to be, changing jobs or changing locations, it is a little bit more flexible to rent. You also may have a sense of community because, you like Kathy had mentioned, with when you're living in an apartment building, right, there's people that you see in and out every day. And also it's a little bit, you don't have to worry about the maintenance, right? You can kind of come and go as you please. And depending on your lifestyle, that may fit you better. All right, and some of the cons, right? So you have a little bit of limited privacy, obviously, like we talked about. If you're living in an apartment building or a multifamily home, you might not have access to, a yard and be able to, have barbecues and family members over and things of that nature. If you have animals, even that becomes something that comes up. You may only be able to, have one dog or one small pet. And you're really not seeing many of the tax deductions that you would benefit from by purchasing a home, and your rent can increase, over time. So, you have more moving costs and you're not really building equity. I mean, you're building equity, but not yours. You're building your landlord's equity because you are paying a mortgage one way or the other, even though you are, you don't own the home. And so we're going to kind of look at the same pros and cons for buying a home, right? So, that's the biggest thing, right? To make a home, it isn't just a house, right? But to make something a home, you need to make it yours, right? So being able to personalize it and doing the things that you want to, whether that's, changing the paint or the trim or the design in the kitchen, bathrooms and things like that, which gives you a nice sense of gratification and pride in that home ownership, right? And you have, obviously, you're going to have more privacy because you own the property, and you're going to be able to put down some roots and make friends with your neighbors and have your children grow up with their group of friends that they have good relationships with. We're also building some equity, and as we're paying down our mortgage and amortizing that loan, we're building equity along with the appreciation over time. So that really does bode well for your being able to build some wealth through real estate.
Whoops.
Some of the cons, right? So there is going to be more of an upfront cost In most cases, if you're renting your property, you're probably just, paying your first month's rent and maybe a month and a half security, and maybe a small real estate commission. You're always going to have to do some maintenance on your home, right? So that's part of kind of getting you qualified and making sure, you do have a decent safety net for the just in case things, right? And if you do want to move, there is some more things involved, right? You can't just break a lease and leave. You do need to sell the property. And like we talked about, you're probably going to acquire more stuff to move. So it does become a little bit more cumbersome if you're constantly, changing locations with a career or things of that nature. So this is kind of an example of, the difference between buying and renting over a 10-year period. And these are just kind of the baseline numbers. And in the next slide, we have a little bit broken down and kind of how we got there. So you'll see, we base this on a, $500,000 home, where, your average rent in North Jersey is probably going to be somewhere around $3,000, depending on square footage and location. The one thing about renting is that your landlord can raise the rent up to 4% every year, right? So on average, we see between 3.2 and 3.5%, where, your rent can increase every year. Whereas with a mortgage, the principal and interest of your loan is always going to stay the same as long as you're in a fixed rate mortgage. And also, with a $500,000 purchase price with 20% down, it's $100,000, which gives you a loan amount of $400,000. So over a 30-year term, interest rates, like we said, are still very aggressive in the low 3% range. And kind of looking at your cost to, put your down payment and, your closing costs and things of that nature. The mortgage payment is going to be a lot less over time, right? Because you're not going to have those rent increases. We will see a small adjustment in property taxes every year, and homeowners insurance slightly, but that's something that you can shop every year. But based on, the numbers, after a 10-year period, the difference in, the appreciation and the equity that you're going to gain, and not always having your rent increased is going to, give you a pretty good return on your investment over that 10-year period, which we, if you look at the bottom number there, it's about $275,000 in appreciation, and amortization over that 10-year period. So if you plan on, kind of moving very quickly, then, renting is probably, better for your situation right now. But if you're looking a little bit more long-term, to put down some roots and grow your family, then buying is definitely the better option, as long as, you're comfortable with it.
Right. And Stephen, here, we're showing that with the numbers that you've put together for a $500,000 home, you're building equity of about $185,000, right?
Right.
And you've got these rent savings. So overall, it's, again, if you're in it for the long game, if you're looking for an investment, it's something seriously to consider. There's certainly benefits of renting right now, in terms of feasibility, and keeping your costs low overall. It also may be for you right now, it's a chance to save money so that you're saving that down payment, for going forward. And we're going to talk a little bit later, because it's never too early to start planning if you have a goal in mind of eventually owning a home. Right, Stephen?
Absolutely.
Okay. Is this you or me?
This is my slide.
Okay.
So just, you can type in the chat if you're a first-time home buyer or you have, already owned a home in the past. Okay, so we see a lot of responses. First-time buyers. Yep, so it looks like we mostly have first-time buyers. So great to have you guys on, because this is a really good education for you.
Perfect. All right, so then I'm going to take us to the next part of this. And so what we really want to talk about now is the buying process and leveraging the right partners. So I'm going to start here, and it really starts with a pre-approval. So you see here, mortgage lender pre-approval. And, especially in this market, which is so fast-paced and with low inventory and so many qualified buyers out there, you want to get yourself to be considered a qualified buyer. And in the real estate world, what we talk about is a buyer that is ready, willing, and able. You are ready to buy a home. You financially are pre-approved to buy a home, which means you are able to buy a home. And that's the right place to be. And then the next thing we do is when you meet with a real estate agent, you go through a consultation, and that's really, and this is a fun part because it's a needs analysis, and you get to talk about what your goals are and what your needs are so that we can really determine how we're going to approach looking for homes for you. And then we find a home, we then we get to go look at homes, which is fun to do also. And we do follow COVID in this environment. We make sure that we're doing business in a very safe and healthy way. And we make sure that, we bring in, even with open houses, we're bringing in one group at a time. So now you've found the perfect home and we're ready to make an offer and we negotiate. And, part of my job as an agent is to make sure that you're getting the most home for your money. And I've been successful at that so far in terms of, in many towns, prices are going over 100% of list price. So it is something you have to think about. And part of what we talk about with you in this current environment, you are going to receive a budget, what you're pre-approved for. And we look at a couple of different things. You have to consider the list price being the starting price. And what we'll also do is we typically, and Stephen and I will typically counsel or coach a buyer to say, we're going to look at homes that are about 10% to 15% lower than what you can actually afford, because we want to get you in the game. And we want you to get a house because the intent here when you get a house is we want you to enjoy living in your house. We don't want you living and working so that all you're doing is, you're living for your house to pay the mortgage versus enjoying your house. And so we are successful at getting the bid and we go under contract. And as an agent and also as a lender, our jobs are to get you to the closing table. So that's a very quick overview of the process. And obviously, when we meet with our clients, we go through much more detail in terms of what's involved with that. But the process stands on itself, but what you have to do is you want to make sure you're leveraging the right partners. And so you can see here on the right, we obviously, who are the people that are going to help you get to the closing table? So what you're looking for is, finding the right partners that are going to help you get to the closing table and take this process, doing it productively, doing it as profitably as possible, and with the least amount of stress. And so you're looking for business partners that you can trust and that have your best interest in mind. And so when you see here is the three critical partners involved in buying a home is picking the right mortgage lender, picking the right real estate agent, and also picking the right real estate attorney. Now, I want to touch on two things. When you are, and I've seen this, many times, a buyer will say, well, why shouldn't I just work directly with the listing agent? Why do I need to have an agent represent me? I'll go directly to the listing agent. I can negotiate directly with them. I don't necessarily need you. Well, here's the question that you have to ask yourself. Understand that the listing agent is actually representing the seller. They have a fiduciary responsibility to that seller, which means is they're looking to get the most money for that seller. So what ends up happening is you have somebody that you're going to who does not have your best interest in mind. That's why you want to have somebody that represents you. And it would really be no different if you were going into a serious business negotiation. And typically when we go into negotiations in business, when you think about negotiating for world peace, there are two sides. And we want to make sure that there's the opportunity that both sides are represented with the best interest in mind. And then picking not just any attorney, but a real estate attorney. A real estate attorney understands the process and understands the timeliness of getting you to the closing table, because this process has to be over-managed, which again, an agent will help you with, but an attorney that understands the timeline and understands the importance of responsiveness. So let's dig a little deeper and really talk about you, right? Because it really is about, you're finding your dream home. It really is all about you. So when you meet with an agent, you're going to talk about, during the consultation, they really should be talking to you and asking you a lot of questions. And this can be a really fun part for all of you, because you have a chance to dream and to really think about, what are your needs? What are your dreams? What are the things that are keeping you up at night? Do you have questions and concerns? What is my budget? What are my finances? How much do I want to spend per month? What's my timeline? How quickly do I want to buy a home? Is this my first time home, or am I getting my forever home? And how does this fit into the life that you are building? Whether you're buying on your own, as a family, with your significant other, it's all about determining what is right for you. And by doing that, we can then, as an agent, my job is to be a matchmaker. And so as you continue to think about what you're looking for, you're really thinking about, so what's this, what am I looking for? Do I want to live in a house? Do I want to live in a townhouse? Do I want to live in a condo? And then, here, these are the 5 key components. Where am I in my life in terms of, am I moving up? Do I need more space than I have in my apartment today, or my current situation? Do I need smaller space? Do I want to right size if the space is too big? What are the features that I'm looking for? Number of beds, number of baths, some of the amenities, location. Do I want to be in a rural area? Do I want to be in an urban area? These are just some of the things that you want to think about. And the condition. We're going to talk a little bit further about, new construction versus, do you want a fixer upper? Those are decisions that you're going to make. Those also tie into, move-in ready versus I'm willing to put some sweat equity into my house. Those are decisions that you're going to make that will determine, ties into price, because your budget and what you can afford as a down payment with the current interest rates. And you kind of have to look at all of these things. And with an agent, what happens is they will help you identify what are the need to have, the must have versus the nice to have, so that you can prioritize and find the right home. And of course, for some of you, you might own something already. So then you have to think about, do you also need to sell something before you buy? And that all goes into a conversation and a strategy that is really personalized based on your needs. And this type of conversation, we would bring the lender in also, because that would determine in terms of the best strategy. Sell first and then buy. It's okay to buy and then sell. It's a very individual, and we determine the strategy on a situational basis. So Stephen.
All right, so in this example, we're going to kind of talk about, one of the bigger misconceptions to getting approved for a mortgage, right? So a lot of people think that, you need 20% down to buy a home. And there are some options for you, some low down payment options if you are a first-time home buyer, or not a first-time home buyer even, right? So Fannie Mae and Freddie Mac are the 2 agencies that, create the guidelines for conventional mortgages, right? So they do have a couple of first-time buyer programs that will allow you to put as little as 3% down. However, there are some income restrictions that do come along with that, but you can do as little as 5% down with a regular conventional mortgage if you do exceed those income limitations. Also, an FHA mortgage is a government-insured loan, so you can actually put 3.5% down there. But one of the things that you really want to keep in mind is, because of the market that we're in and how competitive it is, you do need to come in with a strong offer. And, one of those things is, sellers view a stronger down payment as better qualified. It's not always necessarily true, but that is, one of the thought processes that will go through a seller's mind, when choosing the right offer for their property.
Yes, and that's a situation we're seeing. We've seen in 2020, in 2019, you know, the idea of someone putting down 3% was perfectly acceptable. Now in this area, you know, typically to be able in this muddle, when you're in a multiple bidding war, that's where sometimes the investment has to be larger, because the seller is looking for, you know, the commitment up front in terms of your ability that you are solid and that there is, you know, an investment up front. And again, it's a conversation we have together to determine what is the right solution for you in terms of what your down payment can be, and then how we position that as we present an offer to the listing agent and to the seller to have you win that bid. Go ahead, Stephen.
All right, so we're going to talk about the importance of a pre-approval. And as Kathy mentioned too, right, the housing market is very strong and properties are moving very quickly. So, you know, starting early and really knowing where you qualify up front is key, because, you know, you need to be ready to shop confidently. And also, you know, there are some things that do come up on credit reports that may, you know, cross over because your name is very similar to someone else's, or you may have some digits in your, you know, social security number that are similar to someone with a similar name. So there are some times where we do see errors on credit reports where there might be something there that you were not aware of, and it can take a little bit of time to get those things removed. You know, the other thing is that, you know, when you're shopping with a realtor, right, they want to make sure that you're well qualified, right? There's very, you know, as Kathy said, you know, the real estate market is very competitive right now. And also people wanting to stay safe, right? They don't necessarily want, you know, people in their home that are not ready, you know, ready, willing, and able to purchase a property. Prior to the pandemic, you could go to a listing with your agent with no pre-approval letter, or go to an open house and things like that and view a home without actually getting qualified up front. And so now people are taking a lot more precautions there. So it's really important to start early, but not always necessarily just the maximum you qualify for, right? You want to be able to shop confidently in the price range that you're going to be comfortable with the monthly obligation, because we can pre-approve you for the max you qualify for. But if that doesn't fit your lifestyle, then you know, you can get yourself into a situation where, you know, you're just going to be working to pay for your home. All right, so we're going to look at here the three things that we actually look at getting you qualified, right? The first thing is credit, and I'll touch on kind of what makes up your credit score. So the biggest factor is your payment history, right? You want to make sure that all your payments are on time, which makes up a good chunk of your credit score, which is 35%. And there are some misconceptions, right? If you have a payment that is due, let's say on the 5th, and you miss that payment, if you pay it on the 10th, it's still not going to report late on your credit, right? It's not late until it's 30 days late. So don't think just because you're a few days late and you got a late fee that you should wait till the next billing cycle to pay it, right? If you make that mistake, your credit score can drop, you know, as much as 100 points for one late payment, right? So the best thing to do there is, if you you know, are having a little bit of delays with making a payment, is really voicing that with the creditor and reaching out to them and letting them know, hey, I need a little bit more time, and they're a lot more willing to work with you, you know, if you're upfront about it, right? The second thing is your utilization, right? Mostly on your credit cards, right? So if you have revolving accounts like credit cards, you want to try to stay below 30% of what that max limit is, right? So let's just say, for an example, we have a credit card that has $1,000 limit. We want to try not to carry over a $300 balance. And also the timing too, right? When does that creditor report? It doesn't always necessarily mean because your payment is due on the 5th, that's when they're going to report. If they report the balance is on the 3rd, that balance will still report. So kind of timing the things with your creditors to when they report and when your payments are due is also something, you know, that's smart to be able to maintain a consistent high credit score. New credit, right? So that makes up 10% of your score. So anytime that you are, you know, applying for new credit all the time, it can bring down your score a little bit. So you want to make sure that you have some good history, right? So never close out a card, right? If you have a card that you are no longer using, or you just use every once in a while, you never want to close that card out. And we always want to make sure that we're also using it as well. You know, if you have a card that, you know, you don't necessarily need to use, just, you know, go put gas in your car, spend $25, $30 to make sure that it is still active, because the creditor can close the account out for inactivity, and you will lose all the history that you've built with that trade line. And the other thing is credit mix, right? So we want to have a good balance. So if you have, you know, let's say a mortgage, a car payment, and a couple of credit cards, that's a pretty good mixture. You don't want to have, you know, a mortgage, a car payment, and 17 credit cards, right? So we always want to make sure that our mixture of credit is good, because that does make up a portion as well. So as far as the three things that we look at when getting you qualified, the first thing is credit, right? So the scores that we talked about, and maintaining a good score is key to not only getting qualified, but also getting you some good terms. And when we look at the credit, we can analyze it with you and kind of go over anything that you may be able to improve on. But it's also going to give us an opportunity to look at what your monthly obligations are. So if you have, you know, car payments, student loans, credit cards, a mortgage, right? These are all things that we're going to look at, and then we're going to make sure that when we look at your income, there are certain debt ratios that we are allowed to go within to get you qualified, right? So based on how much debt you're carrying, plus your new mortgage, and what kind of income you have, we'll be able to figure out, you know, how much buying power that you have. And the third thing is your assets. So we're going to make sure that you have enough funds available for a down payment. Also, there's going to be closing costs. And then we're always going to make sure, not necessarily that it's required, that, but from an advisor standpoint, you always want to have a decent safety net, right? For maintenance, like that's something that we touched on, the just in case, you know, stuff that happens where, you know, you might need to replace something in the property, or, you know, a life-changing event, right? We always want to make sure that we have, you know, a decent amount reserves for those just in case times. All right, so just you can type in the chat, and we want to know if you're thinking about purchasing a home this year or in the future. Okay, good. All right, so so it looks like we have a bunch of people that are looking to purchase in the near future, which is great, because it's good that you came on the call and kind of, you know, get an education now, so we can come up with a plan, right? So when is the right time to plan, right? That's the big question. You know, I think the best answer is there's really, you know, it's never too early to kind of see where you stand, right? You want to make sure that you're coming up with a budget, and so that we know, you know, what we're really going to be comfortable with on a monthly basis, right? I kind of touched on that. It's not necessarily where you qualify, but what's going to be comfortable for you and your family, right? We still want to make sure that you're able to live a decent lifestyle, you know, make your investments, you know, have a decent portfolio, and really be able to build some wealth and you know, have a decent retirement, right? So these are things that we don't always necessarily think about from the day to day, but they are very important for our future. And I did touch on this before, but, you know, we want to be able to make sure that if we do have some adjustments that we need to make to credit, you know, we do have the time to do so. You know, we want to make sure that we're doing our research and really finding out where we're looking to go, and, you know, determine, you know, kind of what kind of features that we're looking for, whether we want some yard space or we really just want the flexibility of a condo where we can, you know, come and go as we please, and the maintenance is taken care of by an association. Right. And you want to give yourself some time to really just take a look at the neighborhoods and seeing what your wants and needs are and what's going to really fit you. So those are kind of some of the do's, right? And as far as the don'ts, you know, we really don't want to, you know, take on any new credit, right? So obviously you're going to have things where, you know, you may need a new car or things happen, right? So that's kind of why we're here, right? We want to be an advisor to you, and, you know, let you know that you can always reach out to us if you do have some type of life-changing event where, you know, you just need advice on whether you should or shouldn't do something. Obviously, we spoke about, you know, keeping our utilization on our credit cards low, so we don't want to, you know, have too much debt that we're carrying, or, you know, have, you know, miss any payments, right? changing jobs, that's also something to touch on, right? It doesn't necessarily mean that you can't change jobs. It's really more of the how you're getting paid, right? So if you are a W-2 employee and then you go up, open a business, and now you're self-employed, how you generate your income has changed. And then we might want to, we're going to want to see a history of receiving that income. And just being as frugal with your money as possible, right? I mean, I think that's something that we all try to do on a day-to-day, but sometimes you can, get into some situations where you're dipping into your savings. So that's why we always say that, it's good to build up a good set of reserves so that you can, have that flexibility if something, does need to get, you need to spend some money that you're not normally spending on a month-to-month basis, but we just have something that came up, you need to replace the transmission in your car, or, something comes up. So we always want to make sure that we have a good set of reserves to fall back on.
Okay. So that really completes the first portion of this, which is our, just sharing with you what's happening in the market and, hopefully understanding better the process and also what the situation is about what you need to think about becoming pre-approved. We do have questions that had come through that Ken had shared with us. This was as of yesterday, so we apologize if we missed any questions, and we obviously will also go to the chat for any additional questions. And I think we're in actually good shape time-wise right now. So Stephen, I think the first question is actually for you.
Yeah, so I can handle this one. All right, so we did talk about credit, right? That's a major factor in getting good terms on your mortgage. As far as what we view as top tier for a mortgage is 740 and up. But obviously the better the score, the better the terms are going to get. But 740 is the top tier for us. You're probably going to want to, a minimum credit score is going to be a 620. Even with an FHA loan, the Department of Housing and Urban Development has raised the standards a little bit. You used to be able to go a little bit lower, but now they have kind of gotten a little bit more conservative there. I don't think that's a bad thing. I think that, if our scores are a little bit lower, we can certainly guide you in the right direction and how to improve those scores, whether that's, getting some negative items removed or just, helping you build a little bit more positive credit. And the next question you had was about, student loans, right? If you have high student loan debt, yes, that can affect your borrowing power, especially right now, because a lot of these loans are in a forbearance period where you might not have to make payments, depending on if it's a private loan or you have a government loan. Some of them have just been automatically put on hold, and if that does happen, if there's no payment reporting, if the credit report says zero payment, we will use a percentage of what the balance owed, depending on if you're applying for a conventional or an FHA loan. Like Kathy, this sounds like number 3 sounds like your lane.
Number 3 is my question, so I'm happy to answer it. So let's talk about this for a moment. So it's been interesting this past year in terms of 2 parts of the buying process. When you go under contract as a buyer, you bring in a home inspector and they identify if there's any issues in the home or if everything is working properly. And there really are three big things that are structural, mechanical, and environmental that a seller is responsible for. And so this past year, it's been interesting because home inspections and appraisals have been 2 things that have been put on the table that buyers have actually been willing to waive. So they've said, I'm not going to do them because they want the house that much. I personally, as an agent, I do not think that is the right way to go. I think that it's important to do a home inspection. We are in a multi-bidding situation in many cases. So if there's somebody that's willing to give up a home inspection compared to perhaps you that is going to do the home inspection, there's a possibility that your offer would be rejected. But quite frankly, there's different components of what a seller is looking for. And the way that I've positioned, and we've been very successful in winning bids, is that what we do with home inspection is that we commit to the seller that we're not going to nickel and dime them, that we understand that home inspections are really for big things. And that again would be something structural, something mechanical, or something environmental. So, you know, structural meaning that there could be a problem with the foundation, or maybe there's a problem with the roof. Mechanical could be your furnace, you know, or maybe a problem with the air conditioning. Environmental could be that there might be termites. And the way that home inspections are handled, they're either handled where a seller will agree, you know, you may have a list of 10 things. As a buyer, if you ask for all 10, your offer is going to get rejected. You are going to come up with a priority with your agent and your attorney. You're going to come up with a priority. You're going to ask for those things. And the seller has a choice to say, yes, I'll fix them. No, I'm not going to fix them. I'm not going to do anything. Or I'm going to give you a credit towards getting those fixed, which means as a buyer, you'll take care of them. So I would say be very cautious about anyone that you work with that would ever say that it would be okay to skip a home inspection. And the total picture, what you're of the terms, or what's important to a seller, what your price you're offering, what the closing date that you're looking for. Are you going to be someone easy to work with in terms and reasonable for home inspection? And that, you know, and I would never waive an appraisal. So I hope, long answer, but I hope helpful. And obviously, you know, on a one-on-one basis, we could talk about that further. I think the next one is mine also, Stephen. If a home is in pending status, can you bid or put an offer on property? Well, this is the way I'm going to answer this question. In New Jersey, you would not be putting an offer in once it's in pending status. Pending status is also under contract. It's how it's referred. In New Jersey, you are legally able to put an offer on a property that's in attorney review. And so people have done that. You know, the offer has already been accepted by the seller, and then someone else comes in and they bid higher. And that seller has if they'd like to, they can accept that new offer. So, you know, it's legal in New Jersey. The question is, you have to think about it from a morality standpoint and an ethical standpoint. And how would you feel if that was happening to you? And it's really a question, but legally you can put it in attorney review, cannot put it in pending status. Now that may vary by state. This next one, what month is the best time to buy a house? Well, you know, it's interesting. When you step back and look at the real estate industry, the simple answer, every day of the year is the best time to buy a house, honestly, because there are always homes on the market. Even in the pandemic, when we were totally shut down, there were houses coming on the market. Now, when you step back, there is something called the spring market, which is what we're in right now. Typically, that's when a lot of homes come on the market. The pandemic has, you know, limited that. So we're still in smaller inventory. I do think with the vaccinations rolling out and people feeling like they can move around and be able to be out in whatever the new normal is, we do see and we're hearing that there should be more inventory coming on the market. And then the next time that, you know, people are looking at, like, I need to buy a house because I want my kids, you know, situated for the summer so they're ready for the new school year. Now with remote learning, there's also, you know, that becomes not, who knows whether we're going to be back in the classroom officially in the fall or not. That's a question mark. The next time, like the second big market traditionally is in the fall, that August, September, October time period. But again, honestly, every day of the year is the best time to buy a house. It's really up to your situation and your needs and your timeline of when you want to buy a house and are ready to buy a house.
Okay, so
you want to talk about this a little bit, Stephen, together, how to find a property that'll increase in value?
yeah, absolutely. I think there's a couple factors there, right? Development is certainly one of them. If you're in an area, you know, or looking in an area where there is a lot of development, whether that's, you know, businesses, shopping centers, things like that, where maybe it was a little bit more, you know, desolate, I guess you would say, prior to the you know, people bringing in businesses and things like that. So that'll certainly help you, build some value. But I think probably the best way to build some equity in a home is by making some improvements, right? It is very common. We are in a world where everyone kind of wants instant gratification and move-in ready property, but the reality is the best way to build value in a home is by doing the improvements, either once you purchase the home or even through a renovation loan, which is something that is available that we do. So that would probably be the best way, from my perspective, to build some equity, is to find a property that is maybe move-in ready, but maybe isn't brand new as far as the finishes, and where you can have the option to make it your own, with your own style, things like that, but also by improving the equity by renewing things a little bit, whether that's kitchens, bathrooms, flooring, adding an addition, things of that nature.
Right. And then the other things that I'd like to add to that is stepping back from the home itself. You want to think about the town or the city that you're moving into. So, what's currently happening with, the job market in that area? What's happening with the population growth? What's happening, what's the type of school system does it have? Is it highly rated? What are the economic conditions in that particular area? And, access to activities, the type of zoning that the town has, about whether you can make the house bigger eventually if you wanted to renovate and build. So there's a lot, I think I was counting it up before. I think there's about 14 different factors, but those are some of the things that you want to take a look at. There is a great site. If you're just looking, if you're starting to do research about what town or city you're interested, it's a site called city-data.com, and it just gives you an objective overview of any town that you put in there, and it's a good place to start to take a look at. Thank goodness for the internet. There's a lot, as well as driving through neighborhoods to understand how does that neighborhood feel and how does that city feel for it. And then our last question, at least on the screen, is about, is this a real estate bubble? And so, Stephen, do you want to touch on that?
I do. So, and a lot of you are kind of, thinking of 2008 and what happened back then. The biggest thing is, that was a credit crisis. What we're in right now is not really a credit crisis, as where mortgages were made readily available to pretty much anyone who wanted to take one on. Right now, we have a lot higher, standards for credit, and like I said, income and assets, right? So our underwriting standard are much higher, and even higher, prior to the pandemic, right? So, like I said, the agencies have gotten a little bit more conservative. We are making sure that people qualify for the payment, which that was not necessarily happening, prior to 2008. The real estate market is susceptible to ebbs and flows, which have always been there, which will affect any type of investment. However, over time, we have seen, at least 3% growth year over year. If you're looking at a longer term period, right? So real estate is still a safe place to put your money. And, but like I said, depending on your timelines, right? If you are looking to, move in the next couple of years, then, like we said, maybe renting is the better option. But as far as like long-term growth, it is a safe place to put your money for sure.
So, Ken, do we have additional questions that we'd like to?
Yeah, so I did see a few here.
Yep, Kathy and Stephen, we did have a few questions that came in through the chat. I'm looking at the clock here, folks. It's 7:56. Hopefully you don't mind if we go over a little bit tonight. I do want to get to as many of these questions as possible. First question up is from Toussaint Jordan. And his question is he's asking, is 3 months enough time to find a house? And I'm going to add, to find a house and close in this market. I'm in a lease and I don't want to carry a mortgage and pay for rent in the same month.
Well, there's probably a two-part answer to this. So, Stephen, I think, can you talk to like what's happening with, pre-approval and then actually getting the mortgage commitment? What's the typical timeline right now for that?
Yeah, so as far as a pre-approval, depending on your situation and what you have going on, we can get a pre-approval done in as little as, 24 to 48 hours. I'm sure you've seen it online, get a pre-approval letter in 8 minutes. That is not the right way to go. You do not want to make a emotional decision, right? We want to make an educated decision, right? So finding out what your comfort levels are, what your, goals are, doing a full financial needs analysis and really, setting yourself up for success is very important. So, searching for the property and then saying I'm going to get pre-approved once I find something is not really the right way to go, right? We want to make sure that we're going to be shopping in a price range that you're comfortable with, and that can take a little bit of time, right? We do want to review these things with you. We do want to do our due diligence and make sure we're reviewing all your documents and kind of making sure that the process is going to go smooth, which is really important, which is going to help kind of speed things up for you during the process. So taking that extra time up front is certainly beneficial for you. As far as closing, under normal circumstances, we would close in 30 days. However, there are some things that are outside of our control, right? Appraisers are very busy because everyone's either purchasing a home or refinancing the property that they're in, right? So appraisers are busy. We have seen some delays with getting title work back because, if there's a outbreak at the, a COVID outbreak at the county and they close the vault and the title searchers can't get in to do their searches, that can delay things, right? So there are some things that are outside of our control as far as, COVID is concerned. And also, the amount of people applying for credit these days is a lot higher. So it can take a little bit longer. I would anticipate anywhere between 30 and 60 days. I would say 45 is probably a pretty good bet, but finding a home may take a little bit longer. So I think if I think someone mentioned that they had a few months left on their lease, and they did not want to be, making a payment on the lease and the mortgage at the same time. One of the benefits of purchasing a home is the mortgage is paid in arrears. So the first month that you move in, you're not going to make a payment. So that will free up a little bit of cash flow for you. Also, if you're renting, you will get back your security deposit from that you would put down when you would first move into the apartment or building or even property. So you will have a couple months there of breathing room, even if there is a little bit of overlap.
The other thing to take into consideration is when you're looking for a home is, and there's two parts to it, is the time that it takes for you to really identify the right home. I've worked with, the way that I go about it is we really narrow the focus, but it's really as the buyer deciding, do you know what towns, do you know what cities, do you know what neighborhoods you're interested in? And then also the type of home you're looking for, and the availability of what's on the market. And then in terms of negotiating, the way that I work it with my clients and that I work when we're working with the selling side is it's a conversation about a closing date. So, I have a buyer, I have a closing tomorrow. Their lease was up in February. They actually just carried it over a couple of weeks because we're closing tomorrow. I had another buyer who we actually put the house under contract in August, and they didn't move in until the beginning of February because that was the agreement based on their needs, because their lease was going to be up and they didn't want to pay both mortgage and rental. And that was a conversation that we were able to negotiate together. So so I think that the feasibility of being able to buy a house in 3 months, it's feasible. It's feasible.
Great. Thank you for that. Next question comes from Pixel 3AXL. And the question is, do you need to be in the same job for more than 2 years in order to qualify for a mortgage?
Not necessarily. Really what we're looking for is a 2-year history of work. So it doesn't necessarily always need to be even in the same line of work. As long as you do have a history of bringing in income, we can use it to qualify. The biggest thing is like I kind of touched on before is, changing in the way you get paid, right? So if you're a salary and then you're going into a full commission position where your pay is not guaranteed, that's something that we're looking at. We're going to want a history there. If you're a W-2 employee and opening a business and now are self-employed, we're going to want to see a history there as well. Usually about 2 years. Sometimes we can do as little as a year, as long as it's in the same line of work, right? So, if you were, let's say, a hairdresser working for someone, and then decided to, you had that been there for, a year or two, and then you had a history of it, and then decided to open up your own hair salon, then you might be able to do it with as little as 1 year because of that history. But it really depends on, the parameters of the loan and what it looks like holistically.
Excellent. Next question comes from Caitlin, and the question is, does the seller have to accept an offer above asking price, or can they still decline?
They actually can still decline. It's honestly, there's a lot of different factors, and a seller isn't always just looking at what is the highest price. Seller will also look at, how is it working with this buyer, and the listing agent will know based on working on the buyer's agent, does this look like it's going to be a good fit? They're also looking at a closing date. They are looking at things like the home inspection. They're looking at the appraisal. So it's the different parts of the terms of a sale that a seller is looking for. But it's not always the highest bid that gets the home.
And I have our final question also comes from Caitlin, and that question is, in terms of planning ahead for finding the dream home and setting up the mortgage, should I plan to start to set aside a percentage of my salary for my mortgage? If so, any suggestions in terms of a percentage?
Yeah, I mean, I think the short answer is as much as you possibly can. We always want to, save as much as we can, but obviously, with the cost of living in most areas, especially in New Jersey, that does, become a challenge, right? So it's something that you want to look at, on a monthly basis. Is there any excess in things that I maybe don't need, right? Like I've certainly made some adjustments as far as, just cable TV, right? I kind of got rid of cable. I got a Fire Stick, and it saved me, $1,200 to $1,500 a year, right? So, looking at some of the things that you have in excess and cutting certain things out will certainly help. I would say what you want to kind of do is try to simulate a mortgage payment, right? So if if your comfort range is, let's say, $2,500 a month, and your rent is $1,500 a month, I would say try to save about $1,000, so you're kind of simulating that mortgage payment every month. This way you kind of get used to setting that money aside, so that when you do take on a mortgage, it is something that is comfortable for you. But yeah, I mean, as much as you can really, and try to cut the excess out. But that's certainly something that we can talk to you on specifically based on your scenario, and what other obligations you have that may kind of hinder how much you can put aside.
Excellent. Thank you, Stephen. Thank you, Kathi, for your time tonight. I do want to switch screens here for a second.
Yeah, do you want me to stop share? Okay, got it.
No, I got it. I've got the master control, Kathi.
Thank you, Ken.
No, thank you everybody for attending tonight. I do want to remind everybody that next week we have another alumni webinar coming up. We have Dr. Sean Stein-Smith, who's a faculty member at Lehman College in New York City, who will be talking about Bitcoin, cryptocurrency, and kind of giving us an overview in terms of what it's all about, what's all the hype. So if you haven't signed up for that, visit us online at support.fdu.edu to learn more about the upcoming alumni webinar. And with that, thank you very much, everybody, for joining us. Thank you, Kathi and Stephen, for being with us and sharing with us a ton of information that I think personally is very helpful for folks who are looking to buy their first home. I'm on my second home, and a lot of the stuff that you guys said tonight would have been very helpful to me when I bought my first home many, many years ago. So thank you very much, everybody. Have a great night. Stay safe and be well.
Thank you for having us.
We appreciate your time.
Yes, and you can reach out to us at any time if you need any advice, not just for a mortgage, but anything financial. We're always here to help, whether you want to reach out, via phone, text, or email. We're always here to answer your questions.
Yeah, thank you for your time.
Great.
Have a great night. Be safe and healthy, everyone.
All right, take care.